Hello, everybody. Welcome to today's session of the Trading Room Masterclass session. I'm sorry, your facilitator, Matthew, is not able to join due to unavoidable circumstances. However, I'll be taking you through this. I had tried to get somebody else to join in, but she's also having a few challenges, so I'll just pick this through. I'm sure Matthew will be able to join in tomorrow during the bonds and the treasury bill session, because today what we're basically going to touch on is on the bond market. Now, I know most of you have probably heard about bonds, and we've always looked at bonds as, something from a fixed income. I don't know if you've heard about bonds. Let me not just generalize as guys hearing about bonds. Maybe we can take a minute just for everybody to say something, maybe you've heard something about bond. And we'll just go through this session on a one-on-one. We have this more as a discussion before I share my screen to you guys in just one sec. Maybe we just start with, let's say on the order that you guys joined. Let me just start with Tony. Tony, have you probably heard anything about bonds, or what's your view about bonds? If that's something you'd want to share. Tony? All right, okay. Nicole, how about you? Anything you heard about bonds or something you'd want to tell us about bonds? Maybe you've invested in one.
No, I haven't, but what I've heard about it is, okay, the little knowledge that I know about it is that it's government issued and you need a CBSC account. Yeah, that's all. Yeah.
All right, awesome. William, how about you? Have you invested in a bond? If that's something you'd want to share with us. Okay, can't seem to get a hold of William as well. How about you, Michael? Have you invested in a bond? Michael? All right, okay. Now, I'll just share my screen a bit. Most of it is what you've actually gone through. It's what the notes that were actually shared earlier on, just so that we can have a discussion over them, so that you can also just understand what this kind of securities typically mean. And then also at the same time, we are going to look into what is it that it's actually needed for you as an individual to pick in and, just set up and start investing in the bond section. And so that's one thing that I know most of us have actually been waiting for. What is it that a lot of people have actually been looking at investing, in the fixed income section? We've had a lot of questions as well for investors who've wanted to start investing and begin investing within, say, the difference between corporate bonds and also the primary bond that is issued by the Central Bank of Kenya. That's the fixed rate bonds, and also the infrastructure bonds. I know that's one thing as well that we are going to be talking about in today's discussion. Okay, so just 1 minute. I hope you guys can now see my screen. Sorry. Okay, now, earlier on, whatever you guys have been going through from yesterday has been the notes that you're seeing on your screen. So in case you haven't had time to check through this, please just spend some maybe 20 or so minutes and go through this. Now, bonds are basically a type of security that as an individual, you technically get to subscribe to. So whenever you get to a bond, remember, when we'll be talking about stocks, you learn that one of the things about stocks is that with the stock market, you can be able to buy in a stock and then you paid something known as a dividend. We'll discuss on that, so you don't have to worry on that. When we're coming into bonds, now the one thing that you really need to understand about bonds, on the other hand, is that bonds pay you something that is known as an interest. This interest is known as a coupon, and we'll be able to talk about the coupon rate for the bond market as well. Now, the bonds are primarily classified in two ways. We have the corporate bonds, and then we have the government securities. So corporate bonds are bonds that are issued by companies. An example, and let me share that with you guys as well, just right now, is we usually have corporate bonds that are listed on the exchange. And one of the things that you can always see, this is a bonds price list that is issued by the Nairobi Securities Exchange that indicates bonds that are trading on the secondary market. And I'm going to explain to you what the secondary market and what the primary market really is, so that you can be able to understand this before we proceed. Now, at the end, I'm just picking up this. This is purely for illustration. Please don't worry about these figures. I know they're confusing. You can see here, we have, and let me just highlight this. We have the corporate bonds here. And you can see there's a bank that there's the one for Chase Bank. And then there's the one for Real People Limited. There's the one for the Akon Green Bond, the Centum Real Estate, and the Family Bank Medium Term Note. So those are just some of the corporate bonds. So companies are allowed to issue bonds as well. If companies don't want to issue stock, they can come into the market and issue bonds. That's technically what this implies in one way or another. So it's pretty much interesting just how you can see. So we have in here companies getting in and issuing bonds, and also at the same time we have the government coming in. Now, the government bonds are usually classified in a lot of ways. A government can come in and tell you, hey, you know what, we want to build the Nairobi, the JKIA James Gishuru Expressway. Yeah, and then the government tells you, hey, we need 16 billion for this. So what do we do for this? Let us give investors out there a bond called an infrastructure bond. We tell them that this bond is going to pay X amount because it's not being taxed. A project for the government cannot be taxed. So they're just telling you, hey, we are giving in an infrastructure. We'll give you guys a very good rate. Please give us your money. And then you come into as an interested investor, you see the rates and you invest into it. That is known as an infrastructure bond. Anything that is infrastructure bond, I think we've only had 2 IFBs. They're also known as IFBs. So we've only had 2 IFBs since the year began. And that's because one of the things is the approval for IFBs is usually hard. It has to go through a parliamentary process to approve the issuance of the IFB. On the other hand, if you're looking at something that is known as a fixed rate bond, which is also issued by the government, they're also known as FXDs. So an FXD, you as an individual, the government tells you, hey, we need this money for budgetary support. They're not telling you where this money is going to. They're just telling you we need this money for budgetary support. So what do they do next at that bit is they come in and they tell you, hey, we need this money, and you give it to them. You don't know whatever they're going to do it, whether they're budgeting, you don't know which budget they want to put it at. The government has a huge budget. Currently, our budget is, I think, about 3.3 trillion. And so Kenya shillings. And so if the government tells you we need money, you don't know if they want to fund they probably want to fund the Ministry of Defense, or they want to buy some stuff for the police, or maybe they just want to pay, there's no money to pay teachers. So the government comes to you and they tell you, hey, we need this money. And what we want to do with this is, if you can give us this money, we're not going to tell you what you're going to do with it, just for budgetary support. Most of the time you find that money that is going for budgetary support usually has a tax attached to it. They're known as fixed rate bonds. The rates that are usually given are fixed. That's number one. And then also the main reason why because on the budgetary support, most of the things that the government does and purchases with this is likely going to earn some revenue to the government. And so that is why a tax is being pegged onto the government bonds. Also, another thing is retail bonds. A retail bond is, they're also known as municipal bonds. They are purely open to retail investors. In previous years, we've seen Emakiba, which is an example of a retail bond. So when a retail bond is being traded, they don't allow companies or large individuals to invest. If you look at Emakiba, for example, the payment options were that an individual could not hold up to a certain amount, could only hold up to a certain amount of money. Most of this was the transferable limit for PesaLink, which is, I think, 999,000 by then. Right now it's down to 200,000. But yeah, that's one of the things. Finally, we have what is known as a green bond. So companies can issue green bonds, but also the government can issue a green bond. We have not seen the Central Bank of Kenya issue a green bond, but we have seen Akon Group, LLP, actually issue a green bond. Akon, if you don't know Akon Group, that's the company that owns the famous Kwetu hostels. So in case you're wondering, now you know. So whenever you're talking about bonds, the bond, the main reason why it's important to know the type of bond that you're probably investing in, one, it's because of the tax rate. The other is because of the channel of delivery. So that's one thing for you as an investor. It would be very important for you to know. Okay, now there's this bit about where to bid about the bond. I don't know, I hope I'm not going too fast. Please, if I'm going too fast, please let me know, and then we can pause, we can touch on it. Today we're touching primarily on bonds, nothing else. Then tomorrow we'll touch on treasury bills, so you don't have to worry about that bit. Now, on the bond trading, there are two things. There's one thing that is known as a primary market, primary auction or primary market. And then there's the secondary market for secondary trading. Before you invest in the primary market or before you invest in any bond, you need something that is known as, you need a special account known as a CBK CDS. In stocks, we'll be learning about something else known as a CDS, but for bonds, you need something known as a CBK CDS. A CBK CDS is typically just your normal account that you'd use in managing your stocks, but it's purely for bonds and treasury bills by the government of Kenya, and it's held at central bank. I hope we're together into that bit. Anybody here with a CBK CDS? Okay, now the requirements for you as an individual to open a CBK CDS, here are the requirements. These requirements are available on the Central Bank of Kenya's website. I'm sending you guys these links on the chat, but don't worry, I'll also be able to send them after today's, after the class. So later on, probably before 9 p.m. Once the recording is available, I'll send this to you guys as well, the link. But you can check it out on your chat as well. Now, the one thing that we're seeing here is that, first of all, you need to have a single CDS account. So that means you only have one account, CBK CDS. The requirements here is a duly submitted card. It's known as a card, not really a form, because it's a hard paper. And it looks something like this. It's printed on a very hard cardboard. And I'm wondering, why can central bank push some of these things to more of a public, to an online forum? And then I remember that maybe there's somebody out there who still has a tender to supply these cards. You need to have a recent colored passport size photo for you. That passport photo will be affixed Where is it? There's a place where it's supposed to be affixed. I think somewhere up here. Oh, sorry, this is the application for the bond. This is not the card. I'm going to share the card with you guys in a few. You also need to have your bank certify that this is you. So one of the reasons that guys would always open the CBK CDS using their bank is because most of this data the bank will already have. Then you also need your KRA PIN. It looks like the taxman is not leaving you anytime soon. So pretty much interesting. Now you can see on the remaining bit, it's just about your bank as well. Then there's an email indemnity. So an email indemnity is where it's an agreement where you're actually just telling central bank that, hey, you can send me this to my personal email, or if you receive any instructions from my personal email, I will not, I'm liable for it. I will not hold CBK liable. So once you submit this, it will probably take about, to drop this will take 15 minutes, but the account itself will take about 7 working days. And then you'll have the account delivered to you via text, or you'd get a notification on the email that you had actually provided to the Central Bank of Kenya so that they can be able to access so that they can be able to set up the account for you as an individual, and then you can just push through with it. So it's a very interesting bit. Now, we've gone through the initial bit, understanding what a bond is. We've also gone through the bit about getting to know what you need so that you can be able to set up a CBK CDS account. The reason why I'm really pressing on a CBK CDS account is because there are two things. We have the CDS account, which is used in stocks, and we also have the CBK CDS account. So please try not to confuse the two. Now, once you have this, then what next? What happens next from here? So just a minute, just one sec. I share with you guys another screen. Hi, Sue, how are you?
Hi, I'm good. How are you?
Good, good. Welcome to today's session.
Yeah, sorry. Thank you. Sorry, I'm late.
No worries. Just 1 minute, guys, as I load this up, then I share this to you guys. Meanwhile, if you have a question, please feel free and just ask.
There's one on the chat box.
Okay, just 1 sec. Okay, yes. So the best way to open, for me personally, I think as an individual investor, if you wanted to open a CBK CDS, I would advise you to just go directly to central bank. Whatever you're seeing here, there are steps, yes, they would probably charge, the banks would, anytime you trade, the bank would earn a commission. It's a small commission, it's about 0.002%. For you, might see it's a small figure. For me, I believe the one thing about personal finance is everything about money is personal. That 0.2% that you're giving the bank, it will probably add a lot more value to your portfolio. I don't know if that answers you, Nicole.
Yeah, but still, once I go to CBK, I'll still have to go to my bank for them to sign and verify.
Yes,
and
that's
then
correct.
they won't. Okay, then they won't earn a commission when I go to CBK first.
No, you just go to you get the forms. The central bank would tell you to take to your bank to sign, And I know the bank would always try to convince you, hey, you know what, let us open this for you. It's easier. But it's because they're going to earn something from it. And remember, the commission is not being earned from central bank. It's being earned from you.
Okay.
Yeah.
All right. Thanks.
Cool. So once your bank has signed these forms for you, whatever it is that they've offered, now you take time and you know what? You take them to central bank. I know most of us, Kama Mimi, I know like Tumeogopa Central Bank, you're probably seeing guards there every time. If you grew up at a place where policemen were scary, like where I was from. But nowadays, I know most people, getting to central bank is so easy. It take you like 5 minutes to go through that bit and you're done with it. Now, whatever you're seeing on your screen is an example of a bond issuance. So once you've opened the CBK account, you want to buy a bond directly, instantly. What usually happens is the government usually gives the bonds, most of the fixed rate bonds, you see them every month. But for an IFB, it would take, like, just as I mentioned earlier on, we just had the second IFB this year. That was just about, the offering closed, I think 2 weeks ago. And so that's one very important thing for you as an investor to just have a look at. So here you are, the government, now you've been having a CDSC, your CBK CDS account, and then all of a sudden one morning you see on the newspaper that the government of Kenya is looking at a bond. Now this is a fixed coupon treasury bond, an FXD. You can call it a fixed coupon treasury bond, a fixed rate bond, a fixed rate treasury bond, or a fixed interest treasury bond. That's how you can look at it. There are two things you need to understand for a bond. The first one is the interest that is being issued on that bond. The second one is the date of issuance of the bond. And the third one is the period to maturity of the bond. The bond that you're seeing on your screen here, these are three bonds. There is FXD3 2019-10, there is FXD1 2018-20, and FXD1 2021-20. Now this technically means this is a fixed rate bond. This was the third fixed rate bond that was issued in 2019 for a period of 10 years. So this bond is technically meant to mature in 2029. So if you're buying this bond right now in 2021, when it's being reopened, this is an important thing. It's a reopened 10-year and 20-year and a new 20-year bond. So this is a new 20-year bond. The remaining are reopened. So if you're buying into a bond that was issued in 2019, this technically means this is a bond that would expire in 2029. And this was the third rate. This means that this bond was issued most likely in the third quarter. So you need to know that the bond would actually expire would mature towards the end of 2029. If you're buying into it right now, you're going to buy it with a lesser premium. Unlike those who bought the bond when the value was still high, when the premium was pretty high back then, you're going to buy this bond with a lower value. The 2018-20, the value is going to be higher than this because remember, the 2018-20 has a longer period. This is somebody who's willing to hold this bond until 2038. So that's a challenge onto that bit. I don't know if we're together, but I don't know who understands FXD1 2021-20. Anybody who'd want to share their thoughts? Or just make us understand. If you're understanding this, it will be pretty interesting if to just see anybody pick up to it. You can just unmute and share your thoughts on what you think FXD1 2021 means.
Is that a bond that is opened this year for 2021, and the duration is 20 years?
Pardon?
A bond that is opening this year or has opened, the year is 2021, and then the duration, the term is 20 years.
Thank you. That's correct. I agree with this. So now you see, it's something that I know we're all looking at. It's a 2021 bond that's been issued this year, and the term to expiry is in the next 20 years. So this technically means if you buy into this bond right now, then you would probably have until 2041. Can you imagine, guys? I don't know if you're probably prepared for that, but imagine buying into a bond this year and waiting for the maturity in 2041. Pretty much of a long time. I don't know about you. So once you get into this bond, then there are usually the subscriptions bit at which the government would give. And then I'll just be able to explain to you a few basics on this bond, the offer, before you can be able to proceed on to it. If you go into the second page, please let me know if I hope I don't zoom in or zoom out too much. So if you look onto this bit, there's a lot. First of all, there's the coupon rate for each of the bonds. The coupon rate is typically about the interest. The interest here is very important. You'd want to calculate what is it that you're probably earning from this bond. And there are three ways. There are two ways. There's one thing that is known as a market determined average. And that's why you're seeing here, there's an MDA. And then there's the usual rate, which is given by the central bank whenever they're giving the bond. Remember when I told you that the bond that is going to expire very soon is likely to have a lower premium. So that is a lower interest pegged to it. You're seeing the bond that is expiring the next 8 years. That's the FXD1 2019 here, has a lower rate at 11.5%. But then we're seeing that the bond that is the FXD1 2018-20, the 20-year bond, which was issued in 2018, still has a longer way to go, and the rate is at 13.2%. So pretty high. Now remember, for you as an individual, if you're buying onto this bond, you need to be prepared to hold it for 16 years because you're buying this on the primary market. The next bit is just usually about when to expect the payment. And taking an example of FXD1 2019, the FXD3 2019-10, you'd see here the next payment, you should be expecting your interest payment on 14th of February, then 14th of August, then 10th of February, all the way until when the bond matures, when now on 5th of February, you should be expecting the full payment back to your account as well. Now, there's the one important thing as well onto this bit is that there's usually the listing bit. The listing, this bond is moved on to the Nairobi Securities Exchange. Now, what you're doing here, this is a primary auction. This is a primary market. Once you're done with this primary market, there's something that is known as a secondary market. The Nairobi Securities Exchange acts as a secondary market for all bonds that are currently issued by the government of Kenya. The taxation is also important. If you look onto an IFB, you'll notice that there's no rate for the IFB. But if you look onto the FXDs, the fixed rate bonds, which we had discussed on, you'll see here that there's a discount, there's a withholding tax that is being attached onto this bit, onto the bond. Now, this is an example of an FXD. Let me just have a look at an IFB. I don't know if I had one here. Yeah, this is an IFB. Anybody who understands this bit for the period and the issue date for this bond and you'd want to chip in, just a minute and you can say a word or two. So this is the first IFB of 2021 to mature after 21 years. That's correct. And thanks for that, Tony. You're welcome. So yeah, this is just a 21-year amortized bond, the IFB, you know. So it's you just as an individual knowing that this is an infrastructure bond that is being issued by the government of Kenya. Nicole, I can see you've raised your hand.
I have a question just before you go to IFB.
Yes, please.
If you could go back to
The fixed rate bond.
FXD, yeah.
Yes.
So
Yeah.
the one for 13.2% per annum, and its maturity is 20 years. I heard you mention 16 years. Where the 4 years going? Yeah,
This.
Yeah.
Because
so
the bond was issued in 2018.
Okay.
Yes.
Okay.
So I know technically it's supposed to be the bond has taken about the bond's period. The bond has taken about 3 years, 5 months since it was issued, and now it's being reissued again. So it still has about 16 years and 7 months.
Oh, okay, got it.
Yeah. Okay. Now back to this. This is just a 21-year amortized bond for the government of Kenya. Now, the meaning of
Sorry,
bond,
what's an amortized bond?
Yeah, exactly what I was just touching on. So the meaning of
Have you gone through that?
No, it's just what I'm touching on right now. Now, the meaning of an amortized bond is where you find that over the period of the 21 year, there's a high possibility that the government is going to pay a bit of the face value regularly with the interest. If you invest 1 million and the rate is 10%, just an example, you're probably expecting the government to be giving you maybe about another 100,000, and the 100,000 is being paid in 2 batches. So the interest payment for bonds is done semi-annually. So it's being done in 2 batches. So that is 50,000 for every 6 months. But then the government can decide and say that so that we finish this 1 million by the end of the 21 years, let us be paying you back about 55,000. The extra 5,000 is calculated in such a way that by the end of the 21-year period, when the government is paying you the 10,000 or the 55,000, then it will encompass the entire amount that you had invested as well. I hope that answers your question, Sue. And also to everybody else, I hope that is a good explanation. Sue, I don't know if that is okay with you.
It wasn't quite clear. I don't know if you mind repeating.
Okay. Let's just do this again. Just 1 sec, guys. Okay, now let's do this just by an example. You've invested 1 million with the government in a bond. Now, according to the government, guys, what they agree with you is that because the interest rate that you have is at 10%, you know that now the government is the interest payment. So this is your investment. This is the coupon. And then this is now your interest payment. Now, what the government would do is that every 6 months, because we now know that the payment is being made semi-annually. So that's once every 6 months. So that means that the government is paying you 50,000 at the end of every 6 months. Now, because the government is doing an amortization schedule, then what the government decides to do is that because they need to pay you this 1 million at the end of the 21 years, so the government would say that, hey, you know what, we having 1 million. They have in 1 million, and this is going to be by the end of the 21 years. And let's just do that 12 by 21, which is 252 months. So what they do is here, they would say that they would be paying you an X amount of money, an extra 3,968 at the end of, for every interest payment. So this would ensure that at the end of the 21 years, they've paid you your 1 million, but in a very small amount. So at the end of every interest payment, this is what you'll be getting from the government. You'll be getting 50,000 plus that amount. So the amortization schedule that the government has given would now ensure that in this case, you're now getting paid 53,968 at the end of every month. So with the 53,000, the 50,000 is your commission. The 3,000 is basically coming in as the amortization schedule so as to lower the rate or the debt that the government is probably the government is probably owing to you. I don't know if that is clear now that we've done this.
Yeah, now that's much more clear. Thank you.
Okay, all right. Anybody else being left behind? All right, okay. Now, for an IFB, that's an infrastructure bond, this is what we mentioned. I believe Tony had mentioned earlier about just explaining on to what this means. This is an infrastructure bond that is being issued for this year that is going for 21 years. So that means that this bond would probably go for the next 42 years, by 2042, sorry. The face value, so the total amount the government is really looking into is 75 billion Kenya shillings. And that's a very important bit as well. At times, this would give whenever you know the market, the bond is oversubscribed. Now, when you're talking about the fixed rate bond, remember, we talked about the rate that is being issued and something that is known as an MDA. So an MDA is a market determined average. So a market determined average is where the government allows you to give them the rate you'd want to. So an example is if Susan comes in on bond and says, hey, I want my bond at 13%. And Tony comes in and says, hey, personally for me, I want my bond in at say 20%. And then Nicole says, hey, I want my bond at 10%. The government would get an average of all those rates. And then that would be the coupon payment for the bond. So these coupon payments are usually guided because the government gives a leeway of up to 3% on the upside and 3% on the downside from the previous bond issuance, the past bond issuance over the past 3 months. So in this bit here, you're seeing this is a market determined bond. So that means that guys were allowed to bid in the rates at which they wanted the bond to actually come into. And you can see here, the government is giving a bit of the redemption rates. Now, the amortization schedule for individuals, what the government works is the calculation that we've done. However, for guys who've invested above 20 million, you have to hold the bond for some time before you can actually redeem a certain level of the bond. An example is somebody who invested 20 million, you can start paying them the 20 million immediately. Remember, this is a bond that is going to come in to help the infrastructure project for the financial year 2021-2022. And you can see that here. So the guy who's having this bond, the guy who's invested 20 million, they can request up to 50%. They can redeem up to 50% of this bond as at 1st of September 2031. So they have to hold the bond for them for a 10-year period before they can do a redemption on that bond. Now you're seeing onto that bit. You're seeing here, there's no partial redemption that will be paid to incumbent securities on amortization dates. So that's one thing as well that comes in handy. The liquidity on the bond, you can see here the liquidity on the bond. Okay, the listing bit, what we talked about. The most important thing, remember the rates, the period to maturity, the period for the interest payment so that you plan on yourself, and then the liquidity. The listing of this bond is on the Nairobi Securities Exchange. So you've gotten your bit, you've applied for this bond, you've understood the bond, and then what the next thing that you do is to apply for the bond. The application for the bond is this form. All the data that you key in here, these are bonds that will definitely be able to, all the information you key in here is what you get from the two forms, the fixed rate prospectus and also the infrastructure bond. The government is nowadays tech savvy. So once the opening of the account is old school, you have to fill in the paper. But the other rate is you can actually do a bond application through your mobile phone. It's something known as Treasury Mobile Direct, TMD. It's *6 something. I'm just forgetting the code. You dial it, and then once you have your CBK CDS account, you can subscribe to the bond through that bit. Now, in case you want to retire your bond early, that's where now the Nairobi Securities Exchange comes in, an important aspect. Earlier on, we spoke about the primary market, and then we also spoke about the secondary market. Now, what we've been doing right now is the primary market. All these bonds, the prospectus that you're seeing here, these are meant for the primary market. Now, once this is done, then the NSE is the secondary market. The secondary market is just a place where you as an individual, Nicole had some money, 100,000, she put it in on a bond. And it's the end of 3 years and she feels like, hey, I want to sell my bond. I'm in a fix. How does that come in? Or maybe Tony had an interest payment. Tony did not have time to buy the bond when it was being issued on the primary market. But now he's gotten some money and he wants to come in onto the secondary market. How does he do this? Now you see here, if you look onto this bit, onto the bonds, you can see they're classified really, where you have the bonds that are listed. You can see onto the bond period. The most important bit for this, for whenever you're checking onto this price list, is just one. Always check onto the clean price. If a clean price for a bond is under 99, the calculation for the clean price is being done at the central bank. If a clean price is under 99, then the bond has quite a pretty higher value. Anything above 101 for a bond means that the bond is likely nearing the maturity period. And that means the interest payment, you're probably buying it at a higher premium. So that's one thing you need to understand. Now, let's probably have a look at the bonds that we were discussing. At this bit, we were looking at, let me just close this. We were looking at the FXD1 2018-20. On the bonds price list, That was a 20-year bond. And you'd see here, we have FXD1 2018-20. So you'd get all of these in this bit. We were also looking at FXD1 2021-20. Also another 20-year bond, and it's here, FXD1 2021 20-year bond. And that's just how you focus onto your interest payments and also the performance of your bond on the NSE. Any question? Any question onto that bit? Please ask. I think that's it for bonds. So anybody with any question? Maybe we should just have we should go around and just see. Tony, do you have any question?
Yeah, I have.
Yes, please.
Let me start with one. So, at what circumstance would your bond be turned down if you're, because it seems like you're making an application for a bond, yeah?
Yeah.
So would you try and apply for a bond and then it's turned down at whatever cost?
Yeah, actually there are instances where the central bank actually declines bond offers from individuals. The first one is if you invest in 20 million and you haven't included the rate of the bond, that will be declined, because anything above 20 million, anything below 20 million is always considered as non-competitive. Anything above 20 million is considered as competitive. So you have to key in your rate. The other thing is, in case you had once applied to a bond and the government, and you did not fulfill that purchase, so the bond was allocated to you and you defaulted onto that payment. And it's usually a very important disclaimer. If you're looking onto this bit, look at defaulters. So defaulters may be suspended from subsequent investment in government securities. So you applied for a bond and then you didn't pay. And you're seeing here the minimum amount. Oh, I forgot to mention this, a very important bit. The minimum amount you can invest in a fixed rate bond is 50,000. The minimum amount you can invest in an IFB is 100,000. So yes, the government can usually decline, but it's only on those two occasions. So either you default or you've defaulted, or unless you key in incorrect information. But those are usually the main two reasons. The highest one is always about the defaulters bit. Okay.
Okay. I had another question.
Okay, thank you. Nicole, you have any question?
No, I'm good.
Thank you. William, you have any question?
I'd like to ask, could you go through again the dirty price and the clean price again? I didn't quite understand that.
The dirty price and the clean price.
Yeah.
Okay, maybe we can start up with that tomorrow, because I have to get the form as well. I think Mercy should have touched on that, but we can start on that tomorrow.
Also,
Yes.
Does the government verify your source of money such that you cannot launder money through these bonds?
Yes, the government does. Remember, the government gets your data from the bank, and any amount that is above $1 million, the government will have to ensure that the source of those funds are given. You can't actually send money from central bank directly. You have to send it from your personal account. And any information regarding your personal account, that is nowadays a challenge.
Okay, thanks.
All right. Okay. Sue, you have any question?
Yeah, in summary, why is
Yes.
it that the infrastructure bond is considered the best bond to invest in?
It's because of the tax. IFBs do not attract any tax. If you're looking onto this, this is the IFB. And you're seeing here, the only thing that the IFB has is the amortization, which we've talked about. If you're looking at it now in terms of the FXD, there's a tax here, a withholding tax for 10%. So people are always just trying to save the smallest amount of money they can. That's the main reason why IFBs are usually considered as hot heavens, while the FXDs are usually low. And also another thing is FXDs have a flat rate. It's usually about, most of them usually fall in within a level of about 11%. If you're looking at the IFBs, for instance, you'd find that they go as high as about 13, 14%. And you're not being taxed anything. So that's one reason why guys usually love this.
Okay, so I've seen the minimum amount is 100K and the return is say roughly, like for this one, if the period of sale, okay, the period of sale, it's already closed, which means if I want to invest in it, I have to wait until it probably reopens.
Yes, or from the secondary market.
Also, or from the secondary market. And then the date, it means that on the 3rd of, this is the 14th of March, then the 12th of September, that is when, so interest is deposited quarterly.
No, interest for the government is usually done every 6 months.
Every 6 months.
Yes, semi-annually.
But then why does this one show March and then June?
No.
Because I'm seeing 14th March 2022 and then followed by 12th September 2022.
For this is 14th of March 2022.
This is,
and then 7th of September. So between March and September, that's a 6-month period.
Can't you see that's 2026, Philip?
Pardon?
That's 7th September 2026.
Oh, sorry. This is
actually, yeah, actually that's a 6 month difference.
6 months between 12th of September.
Okay, so I gotcha.
All right. Okay. Okay, everybody. I guess I believe it's been an awesome time having you guys on board. Thank you for joining us during today's session. Tomorrow, we pick up another session on treasury bills. The recording of this session will be shared to your email shortly. Thank you all and have a lovely evening. Bye-bye.
Thank you. Have a good evening as well.
Thank you.